Hello and welcome to the Home and Finance Show, and thank you so much for tuning in. I'm Janis Bradley, broker owner of JB Real Estate Consultants, and joining me is my co-host,
Diana Rice-Wilkerson, lender with Fairway Independent Mortgage.
We are your seasoned, trusted advisors, committed to personally navigating you through the home buying and home lending process. This show is designed to provide you with current and relevant information about different aspects of home buying, home selling, and lending and renovation so that you are knowledgeable when making your decisions for you and your family. You can also hear us on Saturdays on Radio 1, 1310 AM, 92.7 and 95.1 FM. That said, if you are in the market to buy, build, or refinance, we would love to represent you. You may reach us at the contact information below. Now on with the show. Diana Rice-Wilkerson, Shelley Gutzman.
Hello.
Hello.
This is exciting.
Isn't this been a great day?
It has been, and Diana's going to lead the charge on this one.
Oh my goodness.
She always gives us great information.
She gives us great information. And I'm telling you, I've been saying to everybody, you know, and we want to say it all the time, get your pen and pencils.
Yes.
Get your paper and pens. Yeah, the paper and pens. Paper and pens would be, pens and pencils would be the same
You can
thing.
already tell what zone we're in.
I just like that.
Hey, this is while she's saying get your pen and paper,
Right.
while the young person has clicked the phone on and said record, right?
Now, we won't even start there. That's a story behind that is for sure. But this afternoon, today, what we've got is Diana Rice-Wilkerson, who you know is the lender. She shows you the money. However, what she's going to talk about today, might be a couple of possibilities she may not be able to show you the money if we don't follow her rules. Right, Shelley?
That's right.
Okay, but this is just helpful information. And Diana, since you show us the money, you show the lenders, everybody the money, kind of tell us what and what not to do.
Yes, because Janice has told me that was my job to show you the money. And then you guys know we give you straight talk and insider information. And so today what we're going to be talking about is how you sabotage your pre-approval. You know, 10 ways that you sabotage your pre-approval. It happens, and it happens more often than what we know. And so what we are about, obviously, is educating you so that you just don't get into this trap. So first of all, what I'd like to say, ladies, is I think when we pre-approve buyers, they think, okay, I'm done.
Right.
Okay? And they just kind of go on with their life. But what has not actually, penetrated. This is a moment in time today, okay? And you know what we've pre-approved you with based on what you've supplied information-wise, documents, the whole entire thing, that is not going to stay frozen. We would love to freeze you right there. We'd love to freeze you, freeze your income, freeze your bank account, but it's not, okay? And the further you get away from that pre-approval date, okay, then life starts to kick in. Real life starts to kick in. And what you think in your mind, this is what I mean, because, we've been there, we understand. I'm still working, right? I have money in the bank, right? I've not done anything wild and crazy, right? So I'm still good, okay? A few months later, you find the house that you love, you put an offer in, and here comes the new documents, right? And you no longer are approved. What the heck happened? There are 10 things that we want to talk about today that absolutely we do, you do, I've done. Normally when I'm talking to you, I've already done it, maybe more than once. That will sabotage your pre-approval. The first one, ladies, opening new credit.
Oh my.
Opening new credit. A couple of things happen when you open new credit, okay? Number one, there's a new debt that's going to potentially affect your credit score. So the score that you had when you applied and the score now dropped, right? Also with that new debt comes another monthly payment, potentially. And what did that do? That dropped the loan amount you were approved for. So what you were pre-approved for, and now we have this contract, maybe a month or 2 or 3 later, you no longer qualify for.
and I know this feeling because I've been here before, but you're pre-approved on the house, you put the offer in, but you just found the perfect living room set that you must have.
Must have.
And it's no payments for 120 days.
That's right.
Is that okay?
No, it is not.
Okay.
120 days, I'll be in my house by then.
I know it. And I still have no payment.
Yes.
So
Right.
what is it? So what the problem is, guys, is there's two problems. You're using your logical mind. That's number one. And so this is something Janis and I have been saying, and this is my thing. Don't use your logical mind in this process, because you logically are saying, hey, I opened an account, I don't have any, I got a new debt, but it's not really a debt. My furniture's not delivered, I'm not closed, I don't have a payment. What's up, Diana? Well, number one, contractually, you have set up a new account. And even though that payment may not have kicked in, it's going to kick in. And anything like that, we have to consider, okay? So that's the problem with opening new credit. That's just one example, okay? The next example is changing jobs, okay? I'm working, I have a solid, maybe I'm making $65,000, $70,000 a year. Hey, this new opportunity I have is going to have me making even that or more money. Maybe it's going to have me, I can work from home versus now going into the office. What's wrong with that? Okay? I'm going to give you an example. So, person might be making $25 an hour, and then they have this new opportunity, same line of work, new opportunity, and maybe they're going to be making $20 an hour, but in this job they get commission. So net, they're going to make more money, right? In your logical mind, you're saying, hey, I'm putting myself in a better position.
Okay.
Guess what, guys? There's a thing called qualifying income. And we're going to be using this term more, qualifying assets, qualifying income. Commission income is income that you have to show typically a 2-year history of receiving. If you're going into a job where there's great potential for commission, and say you even been on the job for 2 or 3 months and we can see the commission, you've not done it long enough. We don't consider it stable. So it's not considered qualifying income. Can't use it.
So that's not the logical mind.
Logical mind, you cannot say, I'm going to better my position.
Right.
And so there can be nothing wrong in this situation if I'm bettering my position.
So let's just stop right here because just the couple of things we've done, 1 and 2, but especially on that particular example that you gave. So, we've been doing this business together for a long time, but I noticed lately, and I say lately, maybe it's been in the last couple of years, but now I hear it in every conversation, is to start early. Yes. Okay, so have things changed to a point, or these are kind of some of the things that have come up while you are saying start early? Because these are the kind of things, especially when you're talking about the fact that they change jobs like that, and the commission in their mind makes them look better. Right. Okay.
Janis, I'm going to say since COVID. Okay. I'm going to say since COVID, and then a lot of that is because a lot of folks' work situations changed behind COVID, whether it was reduced hours or whatever, and so folks are more mobile. They were on a job for maybe 5, 10, 15 years. Maybe that company closed, right? Now you have folks trying to figure out where they fit. And it might take 2 or 3 moves before they know that. That doesn't mean they have problems with credit. That doesn't mean they have problems with income. But if they change a job to a different type of pay, and some of the income we can't count, right? If you've started early, then you've got to be on this job a year. You've got to be on this. And if you call your lender before you start the job, you might just want to delay your start date.
Some people have done that.
And they do that.
Yes, you've trained them well.
I've got a great opportunity. Hey, listen, you are to close on your loan in 30 days. Ask your employer, your new employer, can you start in 45 days, right? Stay on this job until you close. Right?
I have a question because you brought up COVID, and a lot of companies went to work from home, but now that they're asking their workforce to come back, what they're doing is saying, okay, you can work through at the office Monday through Thursday, and now your work week is only 36 hours.
Yes.
Right.
So how does that change? Because before their income was based on 40 hours a week.
Right.
And now at 36, they're like thrilled they get to go home and be home on Friday. But that 4-hour difference, I mean, not only does that go into the payment calculation, but do mortgage lenders even consider that as full-time at 36 hours?
We do, and basically, and good question, Shelley, deep answer, okay?
Okay.
Because we don't really look at income as part-time versus full-time,
Okay.
even though we do and we don't. But we look more at what are your guaranteed hours.
Okay.
So you could have 30 hours a week guaranteed, and we're not into whether it's part-time or full-time.
Okay.
We're into the part that you guaranteed. Now, what we expect to see is every time you get paid, we expect to see
Same.
30 hours. You can
And the
you
same
can work
amount of money.
every time or more, but nothing ever less.
Right.
And if you're saying 30 hours this pay period and 27 and a half the next and 28.65, you got a problem the
Okay.
next. So 30s has to be 30. And you guys, because the whole world has changed behind COVID, the investor guidelines have tightened up too.
Makes sense.
So a lot of things that we could do, we could logically, I mean, that's why we appreciate you using your logical mind, because we certainly used ours in making some lending decisions and wrote it out and justified it, right, to the investor. But because these jobs today, generally speaking, we're in a whole different world.
Yes, we are.
May not come with that feeling of a stability, like I'm going to keep it, right? Then there's a little bit more scrutiny, right? So that's why if you're pre-approved, how do I sabotage it? This is the way. It's certainly when you're kind of looking at things from a logical standpoint. So what's the best practice? And we'll get into some of these. But the main thing you want to do is if you've been pre-approved and anything changes, the best thing to do is if you think you're getting ready to change something, is call your lender. Don't assume. Don't assume. Okay.
All right, real quick. Okay, just because we had a situation like this, and new construction.
Yes.
So, obviously, before the builder can build, they have to have a pre-approval letter.
Yes.
So let's talk about the do's and don'ts on new construction.
New construction.
You know,
yes.
Because what we have been talking about lately, and Shelley, I've woke up one morning and said, okay, buyers, sellers, whatever, uncharted territory. And this is what we're dealing with in today's market, today, period. I mean, it's every day.
Yeah.
But God he gave it to me. And so, you know, I had a buyer that texted me something that kind of threw me off a little bit, and I didn't know whether to get in or out of bed, you know. So, but he did. God gave me the spirit. God said this is uncharted territory for them. So that just helped me understand. So with new construction, just kind of share with that. I mean, we're talking about being able to shoot yourself in the foot
multiple times.
She says multiple times. Okay.
First of all, when the lender pre-approves a buyer, many times they don't know that they're pre-approving a buyer who might build new. So if I know I'm pre-approving a buyer who might build new, I'm going to give them a whole different conversation. If I'm pre-approving a person who's considering existing homes, I'm going to give them a different conversation. Because basically it feels like, you know, you're maybe going to close in the next 2 to 3 months. If it's new construction, that's a whole different ballgame. That is a very long time, you know, and so there's a lot of stuff that can happen. These situations probably can apply more to that group than any other group. Because what happens after a few days of being pre-approved, what happens is we're just human beings. We get back into our groove of life. Right? And so we're pre-approved, we're happy, we're back into our groove of life. We go shopping, right? Today I can get 30% off if I open a credit card. I'm in, right? Forget the pre-approval has not even crossed my mind, right?
They're in the house.
I already know I'm good. I mean, this is just opening a credit card, right? Yeah. And let me see, I'm gonna open it and then I'm gonna pay off the balance, right? Or I'm gonna pay down, but you don't know how that's affected your scores, right? Because you're in the groove of life. Kids graduating from high school, going into college, you gotta sign for a student loan. Kids in college, there are no payments. There are no payments till the kid comes out of college. You've not even thought about it, but you have just co-signed for a student loan with no payments. And you're saying, what? okay, we've got to project a payment even though there are no payments.
That could be a whole show right
That could be a
there.
whole show. So
Student
to that new construction, the further your wait time is for you to get into your home, the more risk there is in something happening that you may not be able to get into your home, which may lead to you still can buy your home, but you need more money down. You still can buy your home, but the approval, the program that you were approved under no longer exists. Okay? So there's just a lot to it. And we as loan officers, we are moving at the speed of sound many times. So what I am asking you to do, and Janis as well, we talked about this Saturday, ask more questions. Do not assume that loan officer is going to give you all of this, because we live in this world, we don't even think to necessarily give it all to you. We also we assume that you've been pre-approved and you already know you can't open any debt and you can't co-sign and you can't do this. But you know what? We are all moving at such a fast pace today. Sometimes we don't have time to think about it. We just do it, right?
Well, actually, in all fairness to you as a lender, your pre-approval does share some do's and don'ts.
It does share do's and don'ts, but we also don't read.
Don't read.
So anyway.
Okay, so the next question. Let's go on to that.
Okay, so we've talked about don't open any new credit, don't change jobs, no matter how much that income might be going up. All of this is before you talk to your lender, okay? Don't use the money in the bank that you gave the loan officer when the loan officer said, how much money do you have in the bank? And then you had your tax refund check came in and it was $10,000 and you said $10,000, so that's what they used for the approval. Okay, 2 or 3 months later, right?
It's down to $1,500.
You're under contract, it's down to $1,500. Well, Diana, you said I only needed $1,500 to close, which might be true, but hey, guess that other money was what we called reserves, and we needed that. And these are not changes we can just make. 99% of all lending decisions are automated. They go through the computer. So in order to get your loan approved, you might have needed that $10,000. Not that you're going to use it, but it shows the automated underwriter that you have this money to fall back on should something come up.
Okay.
And if it's gone, that house may be gone.
So this is kind of comical, but not. What kind of questions do you get for those who understood that you said, don't spend anything, don't do anything? So what kind of questions, so, when the phone rings and they say, can I kind of share?
Well, they'll say, Diana, I'd like to buy this furniture. It's a sale going on.
Right.
Can I do it? I mean, this could be 1 week before closing.
Yes.
Right?
Okay.
Because my logical mind says, okay, I know I can't open up anything right now. I mean, I just started this, right? But I'm 1 week before closing. And I say to them, don't do it. But I'm not going to have any payments. I'm not going to, don't do it. Matter of fact, I say, don't give anybody your social security number for any reason. It's like if you can't figure out what's getting ready to happen with this account, because sometimes the salesperson is selling. The furniture salesperson is selling, right? They're like saying, no worries, no problem, right? You as the consumer are saying, okay, well, let me call Diana. And then I'm trying to figure out, what are you doing? Are you putting it in the layaway? It's like, okay, don't give anybody your social security number. See, if you've not given them that, we're good probably. There's no new credit if you've not given them that. Don't increase your line of credit, right? You may have an account already with this person, but do not increase your line of credit. So anyway, it's like, don't do it. We all know to don't do it.
Real quick question, just so everybody knows.
Okay.
When is the last time before you close that credit is pulled?
That is so funny. I just was going to ask that question.
Okay.
At the end, like people think, oh, they put my credit up front, they verified I have a job up front. But literally, isn't that something you have to do before you send the money? And don't you verify that, I guess? Great question, great minds.
It was a very good question. You will find that some lenders pull credit before closing on all loan products.
Okay.
Not necessarily, that you don't have to necessarily do that. But you'll never know as the consumer when they do and when they don't.
I see.
Bottom line. So typically it's within a week of closing.
Okay.
Typically. But you guys, that may be what we have to do on this loan program, but something else could come up that we have to check credit for a completely different reason. And if we check it and if we see something that has an adverse impact on your scores, maybe like a new collection account, then your deal may be dead in the water, okay? So the bottom line is with credit, that's why you almost have to freeze your credit. I know you can't freeze your life, but freeze it. Don't you do one thing but pay down debt.
That's a very good idea.
Yeah, just don't do one thing.
Maybe that's what we need to start putting them. Freeze your
credit. Freeze.
Because it takes a time to unfreeze it.
It takes some time. Yes, it does. Okay, so we know we can't use the money. Whatever the money was, you can't use it, okay, that you gave the lender for pre-approval. You cannot use it. Don't retire, okay? Now, everything I'm sharing here with you today, these are situations I have dealt with my customers. So we're not making it up. Don't retire. So let me give you my example. Borrower got pre-approved about September, October of a given year. Great job, great income, moving from one state to Indiana. The company, it was a transfer. Okay, no problem. Then they found a house. This was in December, and this is a hard month. November and December, both are hard months because people are trying to close before Thanksgiving and Christmas. So your emotions are high, and ours are too, because we want you in the house before Thanksgiving and Christmas. This guy, he goes under contract. I get the contract. I'm trying to verify income, only to find out he retired. He put in his retirement papers, okay? And he is telling me, his logical mind, Diana, I can show you what I'm going to get for Social Security. I can show you what I'm going to get for retirement. It equates to the same, right? Yeah. And I even have a part-time job arranged when I couldn't close it.
No.
Why? Because we've got paperwork that says it's a lifetime benefit for his retirement. We've got Social Security saying, here's how much he's going to get. However, there need to be two things that we had to have. Number one, Social Security, we had to have the awards letter, which wasn't quite ready, which was fine. But you actually have to receive the first check, guys.
Oh, wow.
You have to receive the first check.
Makes sense.
Okay? Because you can start down a road of retirement and Social Security and you can cancel it, right? So we want to see that your first check hit the bank. So we didn't close in December. Unfortunately, he had to give up that house, but we did close in March because his Social Security and everything kicked in. But you cannot retire. No, you didn't change jobs per se. And what his mind said, hey, I'm making the same income or more. So he didn't see a problem. Can't retire.
Same thing would happen if you were dismissed then.
Yes, exactly.
Because you would have to show what your other income was,
That's right.
but it has to be seen on paper.
Yes,
not
absolutely. Even sometimes now, even today, like sometimes when people are changing jobs and let's say they're applying today, I want a pre-approval, I'm starting a new job, you know, and we get an offer letter that shows all the details, we still want to see that first 30-day pay stub, okay?
You know, I've seen this, and I don't know maybe if that has been since COVID, but I notice and I've heard that lenders aren't necessarily using overtime like they used to.
That is correct.
Okay, so expound on that, would you please?
So we are taking a closer look at overtime. So basically, we used to take your previous year, your previous 2 years, and your year-to-date, right, and average it out. But we're looking really more closely at also what is your overtime doing? Is it going down, right? If it's changing, if it's going down, and you're getting the sense that this might be going away, it's no longer considered stable. Okay. So it could very well be like, you know, if we're at the first part of the year, you may not make very much overtime because the type of job you have where your overtime kicks in is seasonal, more toward the end of the year. Now, in those situations, guys, I'm telling you right now, we're going to have letters, explanations from management, HR. Somebody's got to tell us that this overtime is not going away. Also, the automated underwriters, okay, they are putting more weight on overtime and bonus. So if you go in and you say, this is the income I'm using, right? Base salary only, great. And you add in overtime, let's say bonus, commission, we know, again, this world we're living in, those may go away. You follow me?
Yes.
So, you know, everything's just not black and white anymore. It never was, but it's a little bit more gray today. So that's why you got to be very, very, very careful and just be patient with the lender when they ask you 1,000 questions, because where we don't want to be is you under contract and we're telling you you're denied for something that could have been vetted up front. right? Okay. Changing work schedules from full-time to part-time. I actually had a lady who worked at a hospital, and this is many years ago, and hospitals went through a lot of changes. She was working 40 hours a week. They reduced her hours to 20 hours a week, and she went and got another job working 20 hours a week for her 40 hours a week, did not tell me. So we already know what happened. Mm-hmm. If you're working part-time, you need a 2-year history of part-time income. Mm-hmm. Part-time income is part-time income. It's not considered stable, right, until you've done it for 2 years. It falls into the bucket kind of like commissions and bonuses. There are exceptions, rare exceptions to some of these rules. It could be the nature of the business that you're doing or whatever, but I'm giving you the general landscape of things. Reduced overtime, we just talked about it. So you got pre-approved with working 10 hours a week with overtime. A few months later, here you are with an updated pay stub. It looks like you're only working 5 hours. That's going to be a problem. So it's going to be important that, you know, whatever income you've provided that loan officer at whatever level you're working, you've got to kind of maintain that. Getting back to your question about new construction, mm-hmm. That's hard. I mean, especially when it's taking maybe a few months to build. All right. I'm going to skip to co-signing for a loan. Okay. That's a problem. Don't co-sign for anybody once you've been pre-approved. Don't become self-employed just because you've been doing this other job working for one of these big freight companies as an employee and now you got your own truck. Don't do it until after you close on your house. And for the self-employed borrower especially, if you're applying today, which is 2023, let's say you applied in January 2023, and so we're going to ask you for 2021 and 2022 tax returns, right? Okay, give you a pre-approval based off of those numbers. Then let's say you went under contract in May. We're going to ask for your 2020, no, let me back up. We're going to ask for tax returns for 2020 and 2021 because, because you'll be filing 2022 this year. My point is this, if you have filed a tax return after your pre-approval, it is going to be critically important that you are filing on the same income. If you are not filing on the same income, or if you think you're not going to file on the same income, then the best approach is for you to extend your taxes, the time for reporting, and close on the income that we have approved you for. And we'll talk more about that in the future. But those are the kinds of things that can sabotage your deal. That's just called real life. And you always want to reach out to your lender before you make any changes once you've been pre-approved.
We are so thankful that you've enjoyed this show, and we're asking you to have a great day, and we'll see you next time.
Bye-bye.